Good morning, everybody. This is Patrick MontesDeOca with the gold market early bird update for December 14, 2020. We have already locked in about $1,440 on a trade that we activated this morning. It was an early trade, actually. The market came down to the low that you see here of 1820, and right below that, the weekly target of 1819 was activated. We published this over the weekend. We published this information in Seeking Alpha, and we'll take a look and review some of the reports that we share with our subscribers prospectively. What I'm doing here as a courtesy in this incredible platform that is live streaming in real time, basically showing you how I apply and I execute the very same intelligence that we published. This information is available prospectively, daily, weekly, monthly, yearly, and cyclically. As we came in this morning, obviously, depending upon your schedule in terms of what time zone you are, this information can be executed pretty much around the globe. It's 23 hours a day as we come into the U.S. markets. And so early this morning, it activated a trigger point from a weekly buy one. It met the target of 1830, and then it activated again another buy signal above 1840, above 1830, with a target of 1840. And this signal actually came in at about 5:30 a.m. in Pacific Standard Time. We did materialize the signal, entered the trade, and the target was completed, 1840, 41. As the market came down below the weekly average for the rest of the week is 1849. It came down below the daily average as well of 1841 and the monthly average that we've had for this whole month at 1840. So what you see here is the market has been trading around the 50-50 standard deviation daily, weekly, and monthly. By coming down below 1840 at 7:30 p.m. on the 13th, the system activated targets of 1830 to 1819. Right here. It continued to test this level, but chopped around the mean, which is what we, or I should say the AI of the VCPMI. It suggests that when the market is trading around the average price, daily, weekly, or monthly, that you observe, because it's a 50-50 standard deviation to the relative implied volatility. And I, as a self-directed trader, want to take the highest probability trades that are identified by the VCPMI in terms of the supply and demand for that session. And what we're looking at is a day session. So the average price for the day session is a 50-50 standard deviation. And the extreme above is 50-90, 50-95. The extreme below is 50-90, 50-95 in terms of the probabilities of the extreme above or below the mean. What we're trading is mean reversion trading, is what it's called, basically, or the reversion to the mean principle, in that once the daily average price is identified, then we can extrapolate the extremes above that average price for that trading session or below that average price for that trading session. Because the reversion to the mean principle is that the price will always gravitate back to its equilibrium. Mathematically speaking, it reaches an extreme level, and we use that probability model to identify that extreme. When it does, that's the high probability trade that we execute. Now, you can trade in between because the volatility above the average is obviously what it identifies is the trend momentum, the price momentum of the market. So, but I personally trade the highest probability. So I wait either till the market comes down to the extreme below the mean or to the extreme above the mean. So we've been trading with a bearish trend momentum, and here is the first time that we identify or complete the target. The first time it comes down, you complete the target, and then you wait for a signal. If you enter the market and you get a signal, you can use the level below automatically as a protective level, and depending upon your risk, your profile for managing risk, you can use 3 different levels of stops. Conservatively, you can get out right away if it closes below, or you can use a dollar stop, or you can pretty much hold on until the market comes down and activates that level below. In this case, between the daily 1830 and 1816, we have the weekly 1819. And that's your target, pretty much. What I do is I match the prices relative to the harmonic alignment of the daily, weekly, and monthly. The AI of the VCPMI tells you that when the price is at the blue level, where you see here is at the blue level is 1830 to 1816 daily, and then you start the weekly blue level of 1819 to 1794. And the algorithm really has simplified the identification of where the buyers could show up or should show up, mathematically speaking, because the value or the market is undervalued here. It's undervalued. And so if you're looking for value, you want to buy into this area. And the market tells you that it's coming into this area. The algorithm prepares you, and it tells you, okay, we're in the blue area where we're looking for buyers. The trigger point is a close above. Automatically, your stop is the level below. You can get stopped out, you get out, or you hold on, depending on your profile. Here, if you held on, or you can add basically more as the signal is active in this 1830 area, and finally we get a buy signal at about 5:30 a.m. and it unfolds and meets the target of 1840. And that's what we did pretty much this morning. We netted about $1,440 so far on just trading 2 contracts. Right now, day trade, there's no signal. The day trade was completed, and now we just wait for the market to identify once again another high probability signal. We recommended over the weekend our clients to hold on to GBTC. In fact, I published an article in Seeking Alpha in the Associated Press, and For those that essentially came in long, we would recommend to, lock in some profits, use a trailing stop. So far, we've made about 15,000 on this trade, and I think we can start to possibly start unloading some of this profit here. We sold 3,000 here. I think what we want to do is lock in, and we trade actively pretty much GBTC as a tradable instrument, not as a currency, because it's not a currency. A lot of people are talking about the market competing with gold as a currency, and Bitcoin is a virtual asset. It's a virtual asset. It's not a currency. Once again, because it is not a tier one asset, you cannot take Bitcoin and go borrow against and say to your bank, I want to pledge my Bitcoin to borrow against. When that happens, that's when it becomes a currency. You can exchange the currency for trade, or you can use it as collateral to bargain. Right now, it's simply a tradable asset, and it's a great asset because as a trader, I'm trading the volatility. We just locked in $13,290 net. That's a pretty good deal on a swing trade, since Friday, pretty much. And I'm comfortable with it. I don't need to grab every nickel and dime out of the market. I go back to my position in gold right now, and see where, and how I can continue to accumulate my metals position on the long side. I think we're looking at the market testing. It tested again this level of 42.90 that comes right into the daily, the monthly average price, and the weekly average price right above it at 1849. I want to show you a report that we published over the weekend for our subscribers, and it's for our private subscribers and Seeking Alpha. And they had access to these reports, as well as our subscribers in the private trading room. Let's take a look at the gold market report as we come in today and see what it basically told us to do. The report was published December 13 at 7:36 p.m. The market, the weekly trend momentum of 1846 is bearish as we come into this week, because the market closed below that 9-week moving average that we use as a filter. One of the filters that identifies the trend momentum. The weekly variable changing price momentum indicator, or the VCPMI of 1849, was also bearish because the market pretty much came below or closed below, activating a bearish price momentum. When it identifies the price momentum, it also tells you the stop. And in this case, it told you that it closed above, this should be above 1849. Stop negates this bearishness neutral. And I think I just want to rectify this here for a minute, please. A close above 1849 stop negates this bearishness neutral. $18.19, it told you to, if you're short, to take profits of 18.19. The market low was 18.20, and this is where I use this Thinkorswim platform, which is a simulated platform for purposes of teaching you as a self-directed individual, and also to execute this information. And if you are watching this or you're a self-directed individual, it's up to you pretty much to execute this in real time for your account. But these are real trades that I'm executing. We are following this. And here we've come down and activated again another trade alert, another trade alert at 1830 on this bar. So we seem to be reverting from the average price daily and monthly here into the buy one level daily, and now it has activated a trade alert. So we want to be prepared, not on this bar to execute, but to see what the close is. At 7:30. So during this time frame for this bar, we watch it. We watch it patiently. And if it closes below, basically, we do nothing. Even if it comes down to 18.19, if it closes below, do nothing. Do not go short between the buy one level that identifies the blue levels of demand. And why is that? Well, going back to the probability factor that we use, that the buy one level daily identifies a 90% probability, the same methodology applies for the weekly, that if the market comes down to 18.19, which is the weekly signal, that it would have the same probability. The difference is that it is a weekly signal, which is a predominantly stronger signal. 29.20, 29.20. We're starting to get some buyers into the market here. $30, $29.30 bid. You can begin to see how the supply and demand exchange unfolds at this level here, and the AI pretty much tells you that on the close of this bar at 7:30, a close below activates a bearish trend momentum or a bearish signal with a very low probability, because the buy signals here, mathematically speaking, using this probability model, are 90%, are 50-90% to the mean. The mean or average price is 50-50 standard deviation. The buy one is 50-90%. So you're already beginning to get into a heavy or a probability model that identifies where the support is. But nevertheless, the market can still, come down into this area, but it tells you if you're trading probabilities, you want to buy the highest probability. So you're going to let go of trades that give you a low probability model, a low probability factor. So you don't sell into 1830 to 1819 and all the way down to 1816. But if you buy up here, okay, if you get a buy signal, this level down here all the way to 1816 is the level where you want to accumulate, depending upon your profile, your positions. And I personally use this indicator for me to position myself in derivatives, in the metals markets. We've been able to show this year a robust return on executing this information, applying the VCPMI like I'm doing, and doing it here in the room. We've been able to generate about an excess or close to 400%, which is phenomenal, since February of this year. It's not a perfect system, and the key is that you want to have the discipline that when it tells you do nothing, you do nothing. Or, if it tells you prepare to buy into 1819, the market comes down to 19, and you use a margin of error as a self-directed individual, you always want to, number one, have a dollar stop, a maximum dollar stop on your trade, regardless of how great it is, regardless of who tells you it's a great trade, or regardless of any system. That's simply prudent money management and risk management. In order for you to stay alive, you want to manage that risk, because sometimes, being that this is not a perfect system, the market is unpredictable. The volatility can expand and retract to levels that one does not anticipate. So you want to manage risk, and this is the whole thing about this business. It's about managing your risk. And what this does for me as a self-directed individual is it tells me the area where I can begin to manage my risk, the area with the highest probabilities, the area where it tells you where the buyers can start to come in, And so the algorithm, tells you when the signal is activated or when you should take the signal or not to. The only signal that I would recommend for you to take would be a close above 1830. Below 1830, just do nothing. Just wait. Wait. Do not take shorts. And if you are short, if you came in short, actually, this is a great time for you to be locking in profits, which is what we've pretty much are recommending to do. As we come into the end of this month, we're also coming in, obviously, to the end of this year. And so far, I think that we've been able to identify the probability that the 1767-68 level that we saw recently might be possibly the low for the year. So that's a pretty bold statement. This low here of 1767.20 on November 30th potentially is the annual low that we are going to see for 2020. What you're looking at right now at 1819 is the secondary low, testing this previous breakout that occurred. And if you're an Elliott wave analyst, then you're looking at a first wave here from 1767 to 1879.80 as the first wave. Second wave, we're in the process of making. And upon completion of this wave, we begin the third wave. And this third wave here should give us the magnitude of 1767, about $100 approximately, $110. So the third leg, as it unfolds from here, from the low, potentially, if the low today is 1820, it should double the first leg. And 1820 plus 200, roughly, you're looking at 2020. As the target for the third leg. We keep getting this confirmation using several metrics. So we are trading the short end of the market to basically see when the wave unfolds or rolls into this bullish pattern. And so coming back to the short end of the market, the short term, you're looking at the possibility that today's low of 1820 could be the secondary higher low that would validate and confirm the bottom is in, basically, that the 1767 was the bottom in the market. So we're looking to activate here a trigger of 1830 based on the daily signal here above 1830. Any time the market closes above 1830 activates a buy trigger. So I'm not looking to sell short here once again, as I am looking to buy corrections. And I would recommend, if you have short positions, short hedges, you can begin to lighten up and begin to take some profits on those until we get pretty much the confirmation. The solid confirmation, again, would be the market going above 1840. Trading above 1840 will bring in the monthly average, and the bullish monthly uptrend would be activated, taking us on the daily. And of course, 1849 would complete the harmonic relationship between the daily, the weekly, and the monthly. Let's take a look at the annual, where we are. Even on the 360-day cycle, you can see here 1840 is a significant level that we want to close above, because then we complete this correction pretty much. And you can see here the energy of the market even coming up to this 1840 level, how the market reacts. So in order to see where we are, obviously short term, then you go back to the daily that we're trading, and we begin to see the activation of the daily. So here it's activating actually another buy signal here. 1830.20. This is an aggressive buy here. We want to buy. We want to buy a gold at the market 1830 long. If you enter into the trade, you can use the 1830 as a level, a protective level here on the close of the next bar. We're looking to add to this trade, to this position here, and we're initiating basically an aggressive long, waiting for the market to close above 1830 to add to our position. You can use these levels below to add to your position long term, depending upon your profile. If you're doing multiple positions, this is a great level to enter into a scale-in position if you're expecting the market volatility to take us above 1830. $18.30 bid. You can see slowly the exchange of the supply and demand occurring at these levels here, validating the integrity, you might say, of these levels and what the AI tells you, identifying it in blue. These are support resistance levels. We use pivot points, which are basic technical indicators and guides that identify the support and resistance levels. But the AI goes a little deeper than that, in that it activates those pivot points in color, in blue, and tells you exactly the probability within that level, with the price level exactly, and where the trigger point is activated. As you can see here, we're moving into more buyers coming in above 1830, and that is increasing the probability that the buy trigger is going to be activated. The conservative trigger is going to be activated. The aggressive trigger is to buy, ahead of the close, and use that close as your stop. And you can manage that a little closer, obviously, with a reversal stop. If we get a conservative close now above 1830, then you can add to your position. This is how I use it to enter into multiple trades, multiple contracts. $18.30, 30 bid. I'm comfortable with what I have here, and I'm prepared, to buy another contract here on the close above at 7:45. So we got about 7 minutes, and the market is trading. It's trading in supply and demand. One of the things that obviously you see throughout the session is that I haven't discussed the fundamentals at all in this trading. I've been purely using the reversion to the mean principle in applying the VCPMI for the day trading session that we're doing. But also I use it in the same principle in managing my swing and my long-term positions. This is what I advise my subscribers in my private trading room, basically how to apply the intelligence as pretty much a GPS. You don't necessarily have to be in every market, in every sector in order to make money. Obviously, the more inventory that you carry, the more complicated it's going to be in terms of managing it, particularly when you get into individual stocks. So for myself, my personal choice, obviously coming in from the background that I have, is primarily to trade volatility, to trade risk and volatility. And you can see here pretty much we are activating what appears to be another trigger point. So we're going to add 2 contracts here to this trade and follow the target of 1840. That is the target of 1840. Automatically, when the signal is activated on a close above 1830, your target is automatically activated at the level above. And you use the level that you're entering, basically to manage your position according to your risk profile. So as I was saying, I haven't mentioned basically anything about the fundamentals, the rhetoric about the stimulus or the political environment or anything else that's going on, which is in complete shambles. Basically, that anybody tries to make sense of it, good luck. I personally look at the market, look at the numbers, look what it's saying, and that's where I make my money. That's where I guide my traders and subscribers in my private trading room to do. Pretty much updating them, throughout the night and the Globex and so on. Markets are getting very active. The volatility in the gold market is expanding tremendously, and it's broken pretty much any previous benchmarks that we've been trading with. And since we're moving into this tremendously bearish picture for the US dollar, just based upon the amount of stimulus that the governments are implementing in the market and will have to implement in the market. I think one of the things the gold market is beginning to recognize fundamentally, if I can get into the fundamental aspect of the market now that I pretty much have my position in place, is that with this additional lockdowns that we're having, once again, we are yet to see the casualties of this additional lockdown. We're beginning already to see the unemployment numbers, 853,000 new unemployment claims filed. I think this is just the beginning of the next wave of the economic chaos that this is causing. And I think those unemployment numbers are going to go through the roof here as we move into the next year. So regardless of who is the new administration or whether the old administration, stays or goes, is going to be the beneficiary of a complete broken economic system that, regardless of any political ideals, what it needs is fiscal policy. It needs additional stimulus to be implemented. We are on the cusp, truly, of this system collapsing on the weight of its own debt. And regardless of, short term, what these guys want to do, so-called leaders, what they want to do, the market needs stimulus immediately. It needs assistance to come into the market in every sector in the economy and also for Main Street. This is the most incredible crisis that we are facing, particularly during a holiday time. And we are being told to stay home, lockdown. The economy is shutting down. So I believe that we are going to see some serious repercussions of this current wave economically. And I think the gold market is beginning to prepare, recalibrate, correcting after the high was made of 2089. And what we have seen is basically the market consolidate, discounting, and really wanting to see the real consequence of this pandemic and how basically it unfolds. And here we are, the market allowing that by correcting, consolidating, and coming down on this level, on this to 1767, which was a 50% correction from the low in March to the high of 2089. And not only it came down into this perfect Fibonacci correction, but it came right into this targets of the code, identifying high probability levels, that this is the area where we are going to see buyers, and potentially the market is going to revert from these levels. So you're looking at a potential reversal unfolding from the low that we made today of 1820, and the confirmation would be closing above 1767, which is closing above the Fibonacci trend line, also closing above the daily sell-to level of 1866, and pretty much entering into the resistance level of the weekly 1874 to 1904. 1941 is giving us the trend line resistance level from where we are. So that's at least, $120 from the low that we saw today. And then we'll see what the market does when it gets up there, because it is also a 23% now retracement from the high that we saw of 2089 to the recent low of 1867. This is the first level using the Fibonacci retracement that tells us it's a 23% Fibonacci retracement from this high of 2089. I think we're going to obviously move into much higher prices here over the next few months, but nevertheless, the market will test these levels here, and the completion of this wave, of this swing correction, you might say, that is happening right now, is pretty much completing the annual formation into this period that essentially begins to unfold the next seasonal target, the next seasonal pattern. So I don't believe that this is a failure in the market, or that it is collapsing or going to collapse. I think, once again, based on the fundamentals that we have and what's happening here economically, you have to add into these corrections. The rest of the market is pretty quiet still. We've been chopping around this level here, so the rest of the markets obviously are chopping around as well. The silver, pretty much met the target of 2432 here this morning, as you can see, and it's chopping around pretty much all over the place. The E-mini has gotten up to 3693, which is the sell-to level, and we seem to be reverting from that level. $31.60 bid, strong bids coming in now in gold. 1840 is the target for this trade. We're getting supply as the AI, identifies, and it tells you when you're in the red zone between sell one, sell two, in red, you can expect this kind of action. Supply. This is supply sellers coming into the market. And even though the market didn't quite go up to the sell to level of 36.93, the high was 83.25. It gives you the range and the validation, and the confirmation is really the close below 36.76. If we get a close below 36.76, it's a short trigger, but we got to see what the market does. If it activates the trigger, it goes down to 36.60 as the target, or it activates that target. The XAU, which is the gold and the silver indicator, it looks like it's breaking down from that third fan line support level. And what needs to happen is the market is got to close above this fan line, or we may come down and test the 131 level, which is another 4 points lower. So the index is giving mixed signals here. The gold index, the XAU. The one that's leading the way here today seems to be the silver market. Looks like potentially it's putting in a reversal. Ideally, if it closes about 24.24, then you're getting a bullish trend momentum developing here with a target all the way up to 24.85. So these are so far bullish patterns that I'm identifying here for the metals for sure. We have a meeting, I believe, this coming week with the Feds and Chairman Powell here. It's going to talk about what their idea is with regards to interest rates here moving forward. I don't expect that we're going to see any action at all with any movement of interest rates. But I think the language is going to be more dovish. I think the language is going to be that we're going to continue to maintain interest rates as low as it's necessary for as long as it's necessary so that we can continue to finance this historic debts that seems to be getting bigger and bigger and bigger as we begin to see the pressure come on economically, excuse me, from the casualties that we have yet to see as we unfold the end of this year in just about every sector of the economy. We still have not factored in those statistics in. I don't think the Feds are going to do anything except lean towards even being prepared to lower interest rates to negative. The 10-year is at around 80 basis points, roughly 70, 80 basis points. And obviously, it's very unlikely that interest rates are going to go higher. It can't go higher on the face of all of this debt. So they got to maintain interest rates at zero to continue financing this unsustainable debt as long as they can. There is no alternative until actually the market itself in the bond market begins to dictate interest rates based on the vigilantes, based on the risk that U.S. bonds are offering as the U.S. dollar reserve currency. And obviously, the solution that is being used right now is to continue to print as much as we need in terms of stimulus, quantitative easing, which is only imploding the intrinsic value of the U.S. dollar and pretty much providing Main Street with a silent killer that is called hidden inflation. And we're going to hear a lot about that. So continue to hold on to your long-term positions, continue to trade the market from the long side, and continue to join me here every morning. And hopefully every time that you come here, you become a better trader. Thank you once again, everybody, for the courtesy of your time. Take care of yourself. Be well. Talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
The Ticker Talker app brings the powerful trading technology tools of the Ticker Talker desktop platform into the hands of its users who are on the go. Ticker